Welcome to today's Explainer. I am super excited about this one because we're taking some of the most intimidating, jargon-heavy banking concepts out there and totally demystifying them. We are going to break down the anatomy of a bad loan. Specifically, we're zeroing in on a term you've probably heard thrown around in financial news but might not entirely grasp, the NPA. And to do this, we're using a brilliant metaphor from our source material, the classic childhood lemonade stand. Trust me, it's going to make these complex ideas instantly click.
Okay, let's dive right into our roadmap for today. First, we've got the lemonade lending machine. Then, storm clouds, which covers SMA and slippage. Third is the main event, the NPA, or loans gone bad. Fourth, the coin jar defense. And finally, number 5, bringing it all together with the whole machine.
All right, Section 1, the lemonade lending machine. This is how the foundation actually works. Now, what's really interesting about our source material today is its unique dual lens approach. For every major banking concept, it basically gives us 2 definitions. First, it explains it like your 5, just to build that pure gut intuition. And then, it gives us the precise version, the exact technical way an analyst would use it in a research memo. So we'll be bouncing between both of those as we go.
So every bank needs money to lend, right? Imagine your auntie giving you her spare coins just to keep them safe. Or say your little brother letting you hold his pocket money in exchange for a tiny piece of chocolate. These friendly money givers, they represent your CASA, current account and savings account deposits. Honestly, it's the absolute cheapest funding a bank can possibly get. So, to make a profit, you borrow that super cheap money, use it to buy lemons, sell the lemonade for a higher price, and keep the difference. That profit margin you keep out of every 100 rupees, that's your NIM, or net interest margin.
Moving right along to Section 2, storm clouds, SMA and slippage. Basically, what happens when loans start to wobble.
Let's look at how this tension actually builds. Because a loan doesn't just spontaneously combust, right? It follows a very clear chronological deterioration. Starts with a simple missed payment, nothing crazy. But then it becomes an SMA, where it starts really wobbling. If it isn't fixed, it experiences slippage, crossing that dreaded line into bad territory, until finally, boom, it hits rock bottom as an NPA.
Let's go back to the lemonade stand. Imagine a kid who bought lemonade on credit is a few days late paying you back. Now, they haven't run off yet, but you know that bad feeling in your tummy? That wobbling kid is an SMA, a special mention account. It is the bank's early watch list. But then comes slippage. This is the exact moment one of those wobbling kids suddenly slips into the bad pile. It's the active transition of a performing loan officially turning bad. Which brings us to this fantastic analyst rule of thumb from the text. A growing SMA pool equals storm clouds before the rain. Seriously, analysts watch the SMA list like hawks. Why? Because it's a leading indicator. If the SMA pool is expanding, it's literally predicting future trouble well before those bad loans ever show up in the headline numbers.
And when those wobbling loans do finally slip, analysts have a very strict benchmark. They are looking for a slippage ratio of under 1%. That's the gold standard for a healthy bank. Anything higher than 1%? Well, that means way too many good loans are turning bad way too quickly. It's a huge red flag, signaling trouble regardless of what those shiny headline numbers might be saying.
Now for Section 3, the NPA, loans gone bad. The storm has officially broken. So what exactly is an NPA? A non-performing asset is a loan where the interest or principal payment is overdue for exactly 90 days. It is a completely rigid, unforgiving rule. The very second a loan hits that 90-day mark, it is officially classified as an NPA, and a massive penalty kicks in. The bank is legally forbidden from counting it as earning interest. The asset is just dead weight. And this is exactly why the NPA classification is so devastating. It instantly stops the money-making engine right in its tracks.
To make this super concrete, let's bring it back to the lemonade stand. Say a kid named Bunty takes his lemonade, promises to pay tomorrow, and then completely disappears. You wait, you hope, but after about 3 months of literally 0 payments, you just have to accept reality. Bunty is never coming back. That intuitive 3-month realization, that is the exact equivalent of the official 90-day NPA classification.
Okay, so the crucial point here is understanding how analysts actually measure the damage. They use 2 main numbers. First is GNPA, or gross NPA. This is the raw, unedited total of all your bad loans, literally all the bunnies out there, as a percentage of your total book. But then you have NNPA, or net NPA. This is what's left over after subtracting the money the bank has already set aside to cover the loss, and pay close attention to the strict analyst thresholds. Under 1.5% means a bank's book is totally clean. Between 1.5 and 3%, that's the watch zone. And anything over 3% signals a fundamentally weak loan book.
All right, Section 4, the coin jar defense, otherwise known as provisions.
You might be wondering, how does a bank not just go bankrupt every single time a loan goes bad? Well, they survive using provisions. Provisions are money set aside straight from the bank's profit to cover these expected loan losses. Banks know, for a fact, that some loans are going to fail. So, they take an expense directly out of their P&L, their profit and loss statement, to prepare for it in advance. Basically, they don't just cry when a loan goes bad. They get ready for it. Think of it like keeping a little coin jar on the side of your lemonade stand. Every single time you sell on credit, you drop a few coins in, just in case a customer turns into a Bunty. When Bunty does vanish, you reach into the jar. In the banking world, the fullness of this jar is measured by the PCR, the provision coverage ratio. Analysts ideally want to see a PCR of over 80%. That means your coin jar is almost totally full compared to your bad loans.
But you've got to be careful. Check out this incredibly insightful analyst warning from the text. Watch for profit growth that's really just provisions falling. Listen, if a bank decides to put fewer coins in the jar this year, their reported profits will look like they totally skyrocketed. But it's an illusion. This is a massive red flag that investors absolutely need to watch out for. The actual business didn't grow at all, they just saved less for a rainy day. And as the source notes, that kind of profit growth simply cannot repeat once provisions hit zero.
Finally, Section 5, the whole machine. Let's see the banking engine in motion.
So let's trace this entire interconnected journey from start to finish. A bank gathers money cheaply from friendly depositors. That's our CASA. It keeps the gap between what it pays them and what it earns, lending. That gap is its margin or NIM. It hands out loans, constantly watching for borrowers starting to wobble, the SMAs, and then turning bad, slippage into NPAs. All the while, it keeps a coin jar ready for that sadness, which are provisions and the PCR.
And sitting beneath all of this is the owner's own pocket money, the capital, measured by CARR. The rules say you can't just use auntie's money. You absolutely have to risk your own. If the coin jar empties, the loss eats your capital first. It is the ultimate shock absorber. Finally, at year-end, we look at ROA, return on assets. This strips away all the leverage and size to ask one simple question. After all that cleverness, how many actual coins did you bring home? ROA proves the pure, unfiltered skill of the bank.
Which brings us to a final thought. The next time you look at a bank, don't just look at how big and shiny their lemonade stand is. Look at their bad loans. Look at their NPAs. Knowing how loans wobble into SMAs and fail entirely, I want to leave you with this question. How full is your bank's coin jar before you trust them with your CASA? Dig into those provisions, and you'll really know how safe your money is. Thanks for joining me for this explainer, and keep learning.